Welcome to Money Flow IQs, where smart money meets smart learning.
We're here again to take some, well, pretty complex source material, boil it down, and give you that knowledge shortcut you need.
Absolutely.
Today, we're diving deep into a trading strategy, one that claims to be the answer to years of losses and frustration.
Yeah, it's called the Unsharp framework. And the story behind it is pretty compelling. The creator says it pulled them out of a really brutal losing streak.
Right, leading to like serious success, buying fancy cars, that kind of thing. So, the stakes feel high.
They do. And when you hear claims like that, you've got to wonder, what's the actual mechanism? What's the counterintuitive insight here?
Exactly. So our mission today is to really unpack that. How do we spot when the market's setting a trap?
And, crucially, how do we trade with the smart money, the institutional players, instead of, well, becoming their exit liquidity?
And the background adds weight, doesn't it? This wasn't cooked up in a lab.
No, not at all. We're talking about someone with 13 years in the game. But 3 of those years were just straight losses, constant bleeding.
Wow. Imagine the emotional toll being told to just quit.
Right? It sounds like rock bottom. And that's apparently what forced a total rethink, stripping everything back.
And they landed on doing the exact opposite.
Pretty much the exact opposite of what most standard strategies teach. Hence the name Unsharp.
Unsharp, because it's not clean, it focuses on the messy parts.
That's the idea. It embraces the deceptive moves, the feints, the stuff that trips up traders looking for those, perfect, sharp textbook patterns.
It's about seeing the trap before it springs.
Precisely. Understanding how the market lures retail in right before a big, sudden reversal.
Okay, let's get into it then. 3 core steps to catching these big moves. Where do we start?
It all begins with step 1. You had to identify what they call the sucker move.
A sucker move, okay. Sounds dramatic. What is that exactly? Is it purely emotional?
It often plays on emotion, yeah.
Oh.
It's basically a sharp, fast push designed to, well, suck traders in on the wrong side. Think stop-loss hunting.
Can you give us an example? Like, what does it look like on a chart?
Sure. Imagine a chart looks incredibly bearish. Clear lower lows, lower highs. Everything screams, short this market.
So retail traders jump in short. Makes sense.
Right. They follow the textbook, but then, bam, the market instantly rips higher, trapping all those shorts. That quick, misleading push down, that was the sucker move.
And the opposite can happen too.
Absolutely. Chart looks amazing. Higher highs, higher lows, maybe a perfect little flag pattern forming. Looks like a guaranteed breakout higher.
So everyone piles in long.
And boom, straight down. Immediate reversal. Wipes out the longs who chase the breakout. That enticing move up was the sucker move.
Okay, so the first big mindset shift is stop chasing.
Stop chasing momentum. Start hunting for these setups where the market is clearly trying to trick people. Because the real opportunity is trading the other way.
Trading with the institutions who are engineering the trap.
That's the goal.
But these traps don't just happen anywhere, right? There must be specific locations.
Exactly. Which brings us neatly to step 2, finding the key levels and the liquidity zones.
Okay, key levels. And the method here involves boxing in the price.
Yeah, that's the term they use. You identify the previous high and the previous low on your chosen time frame, and you draw a box around them.
So you've got this range defined. What are the rules then?
The rules are refreshingly simple. You're looking to buy near the bottom of the box, the previous low area,
And sell near the top.
and sell near the top, the previous high area. Crucially, you avoid taking trades in the middle. No chasing flags or breakouts inside the box.
Why are those boundaries, the high and lows, so important? Let's talk about the low first. What's really happening there?
The low represents where the most committed buyers previously stepped in. It's like a line in the sand. But more importantly, it's a huge liquidity zone.
Liquidity zone, meaning stop losses.
Exactly. Where do most retail traders place their stops when they go long? Just below recent lows, just below support.
Right. Makes sense.
So institutional money needs those sell-stop orders to fill their own massive buy orders without moving the price too much against them. They hunt that liquidity below the low.
So the dip below the low isn't necessarily a real breakdown. It's often the institutions hoovering up shares by triggering all those retail sell stops.
That's the core concept. They engineer the move to grab the orders they need.
Okay. And the highs, same logic in reverse.
Pretty much. The highs was where the big sellers previously showed up, its resistance. But it's also where smart money, who might have bought at the lows, starts taking profit.
They're defending that level, selling into the retail buyers who are chasing the breakout higher.
You got it. And it's worth noting this boxing technique works on different time frames. 5 minute, 1 hour, daily.
But is one better than another?
The source material suggests the higher time frames, like the 4-hour or daily, tend to give more reliable zones. Less noise, more premium levels, they call them.
Makes sense. Higher time frame levels carry more weight. Okay, so we spot the sucker move into a key level, top or bottom of the box. But what if the level doesn't hold? What if it's a genuine breakout this time?
That's a real risk, absolutely. You don't want to just blindly step in front of a runaway train. That's where step 3 comes in. It's the confirmation step.
The protection against catching a falling knife or shorting a rocket ship.
Exactly. This step uses a very specific candlestick pattern they call the pitchfork. You must wait for this signal.
The pitchfork. Okay, interesting name. But hold on. If we're trying to catch the reversal right at the extreme isn't waiting for a confirmation candle, let alone a second one, making us late, won't we miss the best part of the move?
That's the trade-off, isn't it? It's discipline versus trying to nail the absolute bottom or top tick. The pitchfork confirmation reduces the odds of getting caught in a false reversal, a fake out. It confirms the initial rejection has some momentum behind it.
Okay, fair enough. Discipline over greed. So, walk me through the pitchfork. Let's say we're looking for a long trade at the bottom of the box.
Right. First, you see the sucker move often, like 3 to 5 big red candles driving price down hard into that lower box zone. Panic selling.
Okay, got the panic. Then what?
Then you wait. You need to see one green candle print first, just one, that shows buyers are starting to step in, rejecting the lower prices.
That's the first sign of life.
Exactly. But you don't enter yet. The actual entry trigger comes on the second green candle, but only if price trades above the high of that first green candle.
Ah, okay. So, sucker move down, first green candle shows rejection, second green candle breaking the high of the first, confirms momentum is shifting. That sequence is the pitchfork.
That sequence is the long pitchfork confirmation, yes.
And for a short trade at the top of the box, just mirror image.
Exactly the same, just flipped. Sucker move up, maybe 3 to 5 strong green candles into the upper zone. Emotional buying, chasing highs.
The report.
Wait for one red candle to print. Shows sellers are rejecting the highs.
And the entry.
The entry comes when price starts trading below the low of that first red candle. That confirms downside momentum is starting. That's your short pitchfork signal.
Okay. Sucker move, boxed in key levels, pitchfork confirmation. Got the theory. But theory is one thing. How does it play out? Let's look at the examples from the source. Tell us about that NASDAQ short trade.
Yeah, absolutely. This was on the ENQ, the NASDAQ Q futures,
Yeah.
using a 1-hour chart. The setup was textbook. Price pushed up to the upper part of the box, a known resistance zone.
And the sucker move.
A series of green candles, followed by a little poke above the box high that failed immediately. Classic failed breakout, trying to lure in longs right at the top.
Okay, trap set. What was the confirmation candle like?
They waited and then got one solid red candle. The notes mentioned it had a John Wick candlestick with a wick on the top, basically a strong upward wick showing sellers slammed the price back down. Clear rejection.
Perfect signal. And the entry.
Entry was taken just below the low of that first red candle, as per the pitchfork rule.
And how did they manage it? Where was the target?
Interestingly, the initial target wasn't the bottom of the box. It was the middle of the box. Why? Because that mid-zone had been a previous breakout area on the way up, so it was likely another liquidity spot on the way down.
Smart. Taking profit at logical points. Did they use a trailing stop?
Yes, they trailed the stop loss based on subsequent candle closes, locking in profit as the trade moved in their favor. Standard practice.
Okay, good detail. Let's switch gears. The long trade example, S&P 500, right? On a faster chart.
Yeah, the ES S&P futures on a 5-minute chart this time. Setup was at the lower part of the box, and this level had been tested several times before.
Multiple tests, indicating strong buyer commitment there.
Exactly, a really solid support zone. So the trader was just patiently waiting for price to pull back from the top of the range. The sucker moved down right into this known support area.
They got the pullback. Did the pitchfork form?
It did. Price tested the lows, then printed the first green candle, followed by the second green candle taking out the high of the first. Long entry triggered.
Now, this one happened on a Friday, which can be tricky. How did that influence the management?
Yeah, end-of-week considerations. Because the support zone felt so strong, based on the multiple tests, they decided to manage it a bit differently.
How so?
They booked partial profits, took half the position off the table to lock something in before the weekend. Standard risk management.
But they didn't close it all.
No. They felt confident enough in the zone's strength to trail the stop on the remaining half and actually hold it over the weekend.
Risky, but paid off.
Apparently so.
Yeah.
They close the rest for a good swing profit on Monday morning. Shows conviction in the setup.
That conviction based on the level strength is interesting. Okay, final example. NASDAQ Q, again, 1 hour, but this one focused more on psychology.
Right. This involved price hitting the upper part of the box, but specifically near the 25,000 level on the NASDAQ Q.
A big round number.
Exactly. Called out as a major psychological number and a technical resistance zone from the box high. Double whammy.
Did it break through?
No. Multiple attempts to break above 25K failed. Each failure just sucked in more breakout buyers who then got trapped when it reversed. The consolidation looked bullish, but the repeated failures were the key signal.
So they got the short entry confirmation. How is the management different here, especially on the exit?
Similar initial target closed most of the position around the mid-box area, that prior breakout level acting as support liquidity.
But the final piece.
The nuance was closing the rest of the position the moment they saw the first green candle form down near the low of the box.
Not even waiting for a full reversal signal at the low. Just seeing the first sign of potential buyers stepping in was enough to get out.
Precisely. Why risk giving back profit? Seeing that first opposing candle at the target zone was the signal to flatten the trade completely. Protect the winnings.
That's really disciplined. Okay, so let's try and tie this all together. What's the big takeaway here?
I think the fundamental shift is moving away from chasing breakouts or breakdowns. It's about patience, waiting for price to reach these specific high-low range boundaries,
Expecting the market to pull its sucker move there.
and then waiting for that specific pitchfork confirmation to trade against the crowd alongside the institutions who are likely engineering that reversal to grab liquidity.
It flips the script. You're not reacting to momentum. You're anticipating the counter momentum at predefined spots where institutions need to act.
Exactly. And that thread running through all the examples is patience. Waiting for the pullback to the zone. Waiting for the specific candle confirmation. It underlines that core idea. Smart money needs retail losses. They need stop orders to fill their size.
Understanding that mechanism seems to be the key to the whole thing.
It really does. It reframes how you even look at support and resistance.
Absolutely. It's less about a price barrier and more about a liquidity pool waiting to be tapped. Which brings us to a final thought for you, the listener, to chew on.
Oh, yeah.
If this whole strategy hinges on institutions grabbing liquidity specifically, retail stop losses clustered below lows or above highs. Think about the psychology. What makes retail traders reliably place their stops in those predictable spots?
Good question.
What psychological tricks, or maybe even common technical analysis tropes, might institutions rely on to ensure that pool of stop-loss orders is right where they need it when they need it? Consider things like round numbers, obvious trend lines, maybe even news releases. How do they ensure the suckers are positioned correctly for the move?
That's a deep question, exploring how they might condition retail behavior. Fascinating.
Something to think about. How the structure itself encourages the behavior needed for the trap. Anyway, that's our deep dive for today. Hope it gives you a new, maybe unsharp lens to view the markets through.
Hope it helps.
Subscribe for more smart money ideas every week.